All right, I think we'll go ahead and get started. Well, welcome everybody. This is now, I think, our sixth or seventh, all client Zoom call just this year. It's obviously been a very exciting, active year in the market. It's kind of our first real bear, market since the Great Recession. If you don't count, the coronavirus crash. So it's been important to me to keep everybody up to date on what I'm seeing, what their portfolios are doing, and what our expectations are for your money and your nest egg as we kind of go through this and experience this together. Now, I've had a lot of different topics for these calls, through this year, and I'm actually going to review some of them. But this is probably my most predictive slide I've ever put up, which is I truly believe right now the market is heading towards recovery. And I'll talk about why. We've talked before about what recovery means during a correction, during a bear market, and during a recession. And I'll kind of show you why I believe we're through the worst of it, but also help you understand what could push this market even lower, if the economy does begin to falter. So let's get into it here. All right, so this is a review of the market so far this year. This is the S&P 500 starting on the left. That's January of 2022, and that was the all-time high for the market at that point. Okay, now we had our first call this year on January 25th as the market started to drop. And, the topic of that call was that corrections happen, keep a long-term view. Then it became clear that maybe this was moving further than a normal correction. So we had another call on February 22nd talking about managing your portfolio in a downturn. And then in May, I laid out for you what a typical timeline is for stock market recovery. And we're actually going to revisit one of those key slides today. In May, later that May, we talked about, the movement of the market from a correction to a bear market as the market finally, hit this down more than 20% kind of benchmark that defines a bear market. And then the market so far, at least, and I think for good, the bear market bottomed out in about mid-June, down about 23.5%. Okay, now the market then recovered from there over the following 2 months, increasing about 17% from the bottom. And then just very, very recently, over the last couple weeks now, has dropped about 8% from its previous high. And that kind of brings us to where we are today. Now, in June and July, I was calling for my clients for you to be investing cash that was cash beyond what you would need for emergencies and for short-term cash needs. And we talked about some solutions for short-term cash needs, and I urged you to take advantage of this market by buying low in the months of June and July. Okay, so let's again kind of revisit the different definitions of a stock market drop. Okay, we've got the first one here, correction. A correction is a drop of about 10%. Typically lasts about 4 months on average. I'm sorry, it takes about 4 months for the market to recover during a typical correction. Then you have kind of the next worst type of drop, which is a bear market. All right, bear market, typically a drop of about 20%. Takes about 16 months on average to go from previous market high to new market high after a bear market drop. A recession, a little bit worse. Not only do you suffer pessimism in a recession, but there's also a significant economic problem that drives the economy into recession and causes corporate profitability to actually drop. That takes longer. That takes 24 months on average for a market recovery. So as we stand today, we're essentially halfway in between, what we would define as the recovery of a bear market versus the recovery for a recession. All right, we're at about 8 months into this, and at worst, we had a drop of about 24% in the U.S. stock market. All right, so the question is this going to take another 8 months to reach recovery, or is it going to take another 16 months or longer to reach recovery? All right. Now, there's really only one major economic problem that we're facing right now, and that's inflation. All right, which is a problem that we haven't had to deal with for many decades. All right. And I hear from clients a lot this idea that, well, how can the stock market go any higher? If it was at a previous high, how can it go any higher? And I just kind of want to reinforce, why this isn't the end of capitalism and why capitalism continues to work. All right. All right. This chart here shows a very, very long view of the profitability of the companies in the S&P 500. All right. So this is the amount of profit or the amount of earnings per share of stock of a company in the S&P 500. Okay. So if the entire S&P 500 was one company and you could buy one share of stock in that company, all right, going back to the 1800s and early 1900s, the company S&P 500 would have made a profit of somewhere between $15 and $20 per share of stock. Okay. Now, fast forward to the 1940s, 1950s, 1960s, one share of stock in this aggregate company called the S&P 500, right? We're kind of making believe right now, right? They were earning about $30 of profit for every share. By the early 2000s, that had doubled now to over $70 of profit per share. Okay. Now you see some big drops there now. Okay. There's the tech bubble bursting in 2001. There's one drop in the amount of profit per share of stock. Then you have the big drop, which is the Great Recession, right? The housing collapse, the almost collapse of our economy, the almost Great Depression again, where the amount of profit for every share of stock in this company called the S&P 500, this aggregation of all these companies, dropped all the way down to below $20 per share. But then, of course, came roaring back over the last decade, where we saw the amount of profit per share of stock reach all the way to 200. All right. Now, it is very, very, very reasonable to believe that this doubling effect that we can see here, where the amount of profit our companies here in the US can make. Oh, and by the way, this is on a inflation adjusted basis. Okay, these numbers are all inflation adjusted. So they already account for the effect of inflation. So these are real profits, right? It is very reasonable to believe that this trend of continuing profit growth as efficiencies and economies of scale continue to work in our economy, that corporations will continue to become more and more profitable over time. And as companies become more profitable, that is what drives stock prices, okay? More than anything, it's all about company profits. So when I talk to you guys about where the market is and where the market's going, I will often ask you the same question, which is the question I'm constantly asking myself, which is, do you believe that 12 months from now, businesses here in the US will be more profitable than they are today, or do you believe they will be less profitable than they are today? Okay. Now, here's kind of a look at how this economy has affected different companies here in the US. All right, now what you see here is every little box in this kind of grid here represents a different company in the US. Okay, if their box is green, it means that their stock price is up over the last 12 months. If their box is red, it means their stock price is down over the last 12 months. Okay, and then we have it organized by sectors. I'm going to zoom in for you so you can see a little better. All right, so the energy sector, to nobody's surprise, is the only sector of the economy right now that is consistently up, where the companies are consistently, their stock prices are up over the last 12 months. All right. Also doing fairly well are utilities companies. Now, utilities are traditionally very recession proof. All right. And the utilities industry has still done relatively well over the last 12 months. All right. Now, this recession started about 8 months ago. All right. But these are 12-month numbers. All right. Consumer staples are doing kind of a mixed bag, but then every other sector of the economy is down. But you'll notice that even within sectors, there are still companies that have managed to squeeze out profitability. All right. And that's how we know that diversification is so key to sensible investing, because we know that every company will not react the same to changes in the economy. Okay, but let's talk about what I'm still very worried about. All right, I've been talking about Treasury yields and the yield curve all year. All right, because one of the most accurate predictors of recessions is an inverted yield curve. Now, the yield curve inverted for like a moment, back in May of this year. But now we are sitting with a steady inverted yield curve. And let me show you what you're looking at here. Okay, the line on the very bottom is what the yield curve looked like a year ago. Okay, now the yield curve is the interest rate that Treasury bonds pay for different lengths of time. Okay, so a year ago, if you went out and bought a 3-month Treasury or a 6-month Treasury or a 2-year Treasury, you were getting less than 1% on that Treasury bond, similar to going out and buying a CD at the bank. Okay. Now, if you went out and bought a 10-year CD or a 10-year Treasury or a 30-year Treasury, you were getting higher than 1% and almost 2%. That's a very healthy shaped yield curve where the interest rates go higher as the term goes farther out. Okay. That's a normal, healthy yield curve. That's what you expect to see. However, what we have today, and this started about a month ago, is an inverted yield curve right in the middle of the term. Okay, you can see that initially between 3 months, 6 months, and 2 years, the interest rates are going up. That's a good thing. All right. All interest rates are higher than they were a year ago, right? We all know that. But the interest rate between a 3-month Treasury bought today, a 6-month Treasury bought today, and a 2-year Treasury bought today, those interest rates are slightly increasing. But then here's the danger zone. Now they start going down between the 2-year to the 5-year, the 5-year to the 10-year. That means if you go out and buy a 5-year Treasury today, it pays a lower interest rate than a 2-year Treasury. And if you go out and buy a 10-year Treasury today, it pays a lower interest rate than both the 5-year Treasury and the 2-year Treasury. That is an inversion, all right? And it is a very, very strong signal of a recession traditionally, okay? Now, I stress the point traditionally because these are not normal times. Now, you fall into the trap of saying these are not normal times every time the market goes crazy, right? There's always some reason that it's not normal times, but these are really not normal times because the Fed is dramatically manipulating the interest rate market. And we talked about this, right? The Fed, through quantitative easing, became the main player in the interest rate market. That is not a healthy thing. And they know that. So what they've been trying to do this year is through quantitative tightening, quantitative tightening, thank you. Yeah, through quantitative tightening, they're starting to get rid of the treasuries that they've been holding for all these years, and that has the effect of raising interest rates. So they are manipulating the interest rate market, and the free traders, the ones trading bonds for normal investors, are trying to react to the Fed doing this. All right, and I think that's what's causing the inversion more than a signal that businesses are going to be less profitable 12 months from now than they are today. Okay, because if businesses are at least as profitable or more profitable, the stock market will not be lower 12 months from now compared to today. Okay, so let me give you a little brief look at kind of what we've been doing the last 18 months in your portfolios. All right, now, if we go all the way back to the second quarter of 2021, we had really just emerged from our coronavirus crash strategy, and we'd finally gotten back to a normal allocation. Okay, then in December of this past year, December of 2021, we started to get worried about increasing interest rates. And so we decided to do several things to protect your portfolio from increasing interest rates. We sold off a chunk of bonds and put them into structured notes for many of you, but not all of you. Okay, we did that for our more conservative investors who are taking income from their portfolio. We also decided to maintain our international diversification, which is we continue to do, as frustrating as it has been. We minimized the amount of US junk bonds in your portfolio. And then this year, we did systematic tax loss harvesting as the market began to drop. So in March, and then May, and then July, we did tax loss harvesting in your portfolio. Okay. Then back in June and July of this year, I made the strong recommendation that if you had cash beyond what you needed for emergency fund or short-term goals, you should get that invested into the portfolio immediately to take advantage of an upswing in the market and take advantage of this 20% drop that we had that will realize a recovery. It's just a matter of time. Okay. And then for many of you that have had these structured notes, you know that the Barclays note that we have for you, we accepted a rescission, basically a canceling of that structured note, which will get you your money back in September, which we will be looking to reinvest. Okay, so this is a slide that I've shown you guys many times so far this year, and these were kind of my predictions. I've kind of deliberately not made changes to this because I want to be consistent with what I think will happen and kind of show you when I do make changes to what I think will happen. And so kind of where we were at is, I was predicting no recession, no decrease in overall business profitability. I was predicting that business profits would either be stable or growing. Okay. And previously I'd predicted a market recovery within 12 months. I'm now pushing that out to within 15 months. I still think it might happen within 12 months. That would mean we have essentially finished this year off with a positive return in the market. But I'm kind of pushing that out a little bit and saying, well, I think it'll happen by at least the end of the first quarter of next year. I do think the Fed will pause interest rate increases. At least I did. And honestly, I thought the Fed would have paused by now. There is now no chance that the Fed is going to pause for September and could even increase interest rates after that. But I think the Fed will pause sooner than probably the rest of the market is predicting that they will. I think they are going to be effective at slowing inflation. I think we've already seen the beginnings of that. But the continued dangers, the same dangers that I was worried about earlier this year, I'm still very worried about. And that's what I'm watching. And that's for government interference, which Drew's going to be talking about some of the government actions that were taken this year and spotlighting for you the Inflation Reduction Act. I'm still worried about a Chinese debt crisis and the impact on the Chinese economy of their continued shutdowns. Every time there's a speck of COVID in their economy. And then, of course, as we've been talking about, the Fed quantitative tightening, them going too far too fast and really kind of crashing the bond market, which is, again, what I was talking about with the inverted yield curve. Okay, it's not a disaster yet, but those are the things that I'm watching most closely. All right, I would now actually like to turn this over to Drew. One of the things I was talking about here was government interference and the effect of government interference. And one of the big things that the government did this year was the passing of the Inflation Reduction Act. One of the things the government's trying to accomplish is stable prices. That can sometimes be interpreted as price fixing, though that isn't where we're at yet, but we're watching that. All right, Drew, I am going to allow you to go ahead and share your screen now and take over for me.
Great. My name's Drew Brooks, for everyone that I have yet to have the pleasure of meeting. I'm a financial advisor here at Village Wealth, and I just want to go over the main 4 or 5 talking points I find interesting regarding the Inflation Reduction Act. Let me.
Hey, Drew. Hey, yeah, there you go.
Okay. There we go. Can you guys see this properly now?
Yep,
okay.
That looks good.
Great. So the Inflation Reduction Act, I'm sure a lot of you have read about or heard about the Inflation Reduction Act and what it entails. Oops, I'm sorry. Clicked the wrong button here. So I'll go through the 5 biggest talking points regarding this. The first one is the creation of a minimum corporate tax of 15% and also an excise tax on stock buybacks. So how this works is for every corporation with at least $1 billion in income will now have a new tax rate of a minimum of 15%. So every company that you've heard about within the S&P 500, the Dow Jones 30, all the way down to some small cap companies will all be included in this minimum corporate tax rate of 15%. So you've heard, some companies like Google haven't paid their fair share of taxes regarding their profits. This will hopefully counteract that quite a bit. Also, you've heard, over the last 10 years, companies have been doing stock buybacks more than they ever have. What's common right now is whenever there's a tax cut signed into law, some companies buy back shares of their company rather than increase pay to workers, use for research and development, etc. So Congress has noticed this trend and are trying to find ways to fight against this. The second most important part regarding this Inflation Reduction Act is the prescription drug reform, which involves Medicare as well. So the goal of this is to fight inflation by decreasing the cost people spend on important and common drugs. You can see here, there's a 4-step process. Most of it does not start right away. It'll go throughout the rest of this decade, but what it entails is Medicare is able to negotiate the prices of certain prescription drugs. The most common ones have to do with blood sugar levels, blood thinners, some cancer medications. All of those are kind of the first drugs that they're going to negotiate. They're also going to have a $2,000 cap on annual out-of-pocket costs for prescription drugs, but that does not start until 2025. And then from 2026 and beyond, Medicare will start continuing to negotiate more and more drug prices, both Part B and Part D. Let's see here. And you can see here, like I said, also insulin is supposed to be capped at $35 a month, hopefully by next year. Now, the IRS has been sounding the alarm. Sorry, this keeps changing. I apologize for this. So the IRS has been sounding the alarm since 2010 about being underfunded and being unable to deliver on its duties, such as a large gap between the taxes due and what they're actually able to collect. They're also unable to take care of the rising identity theft problems throughout the country. The main point I want to state regarding the IRS part of this act is that it is not adding 87,000 new audit agents to the IRS. It explains that it's going to add up to 87,000 employees by 2031. Most of those positions will just be refilling from previous budget cuts that started way back in 2011. So according to the Treasury Department, funds would cover a wide range of positions, even including IT technicians, taxpayer service support staff, and other experienced auditors who would largely be tasked with cracking down on corporate and high income tax evaders. Again, this does not mean you're more likely to get audited next year. The next main point is the Affordable Care Act extension. So currently, medical insurance premiums under the ACA are subsidized by the federal government to lower premiums. These subsidies were scheduled to expire at the end of this year, but will now be extended throughout 2025. Most of you this won't apply to, but approximately 5 million Americans could have lost their health insurance if these subsidies weren't extended beyond this year. You know, for some small business owners or the self-employed, before the ACA, they were more likely to be uninsured than were employees of large corporations. So the costs for providing coverage often meant that small businesses just wouldn't be able to afford to offer it, and making it harder for the small companies to woo some good job candidates. Now, all of this is within the Inflation Reduction Act, but the Fed will have a much greater impact on how inflation continues or gets taken care of within the next few years. So Jerome Powell, the chair of the Fed, has said to expect some pain coming on the horizon. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. So the goal of the Fed is to get inflation back to around 2% from the previous 8% at the end of last month. How they expect to do this is the markets expect the Fed to continue raising rates, expected another 0.5% to 0.75% rise in September. And like Jon said, he's hoping or expecting rates don't continue to go up throughout the next year. However, you can see here back in 2008, federal funds rate was over 5%. Economies tumbling down. They try to lower rates to help the economy. You can see what's, quantitative easing here, dropping from COVID, and then it's rising again now over 2%. Hopefully it doesn't keep creeping up, but I read an article today that part of the board of the Fed expects it to go around 4%. Hopefully, knock on wood, that doesn't happen. But, I believe the Fed will have a much greater impact on inflation going forward than this act named Inflation Reduction Act will do. And I think John has a couple more points as to, if this will change our philosophy going forward, or if we have any updates to your portfolio allocations.
Awesome, Drew. Can you stop the screen share?
Yes.
Oh, I got it. Okay. Let me. This is it's tougher when you have two presenters, but I like it.
I know. It's having issues.
Okay, there we go. All right. So yeah, so with everything that Congress is doing, this huge act that they passed, it's again, it's interesting political talk, but economics wise, we're still laser focused on what the Fed is doing and what Fed Chairman Jerome Powell is saying. One of the key points that I take from there is in his speech after the Jackson Hole meeting last week, he said, expect slower growth. Okay, slower growth is still growth. All right, and that's what I keep saying is that we still expect corporate profits to grow. We still expect growth. It will be slower than perhaps what we're used to. And one of the points I want to make is as interest rates go up, all right, it increases the cost of money, right? You go to borrow money, you pay more interest, right? We've seen all of that with mortgage rates, okay? Now, just like higher interest rates mean housing prices drop, okay? We've all seen that, right? Houses that were, selling for crazy amounts have now kind of reset to a lower rate, okay? Just like housing prices will come down as a reflex to higher interest rates, it doesn't mean housing prices won't continue to grow over the next 12 months, 24 months, 5 years. Housing prices will still grow as long as, demand for houses exceeds supply. It's kind of the same thing with businesses. When interest rates go up, the value of businesses drops, okay? And that's because the cost of capital is higher, and so businesses cannot borrow to accelerate growth, okay? And so compared to before, when money was really cheap, the value of these companies has dropped, and that is the drop in the stock market that we're seeing. But it doesn't mean that businesses won't continue to grow profits. It just means they're going to grow profits slower than what they could grow when interest rates were very, very low. All right. And that's kind of the final point that I want to leave you with is we need to constantly be thinking about how does this economy affect the ability for businesses to create and grow profits? And are businesses positioning themselves to continue to reinvest in growth? And the answer to that is absolutely yes. Most businesses right now are investing in growth. We see that in the low unemployment rates and the huge number of job availabilities. We see that in growing inventory. We see that in new plants that are being built, and as production's being moved back onshore. All of those very positive things for future business profits. Okay, I think I'm going to go ahead and pause it there and open it up to any questions.
So I've got a question about certificate of deposit, CDs. If the interest rates are going up, the prime is going up 0.5%, 0.75%, a 1 or 2 year CD, let's say $100,000 CD. I went online, I think they pay like 3.5%, 4%. Won't as interest rate, the prime rate go up, won't that affect the yield, and the yield will be higher, won't it, for those CDs? Am I right?
Yeah, that's right. Yeah, CD rates are directly connected to short-term treasury rates, short-term, like the prime rate, the Fed rate. Exactly. Yes.
Well, what is your thought? I'm just out of curiosity about CDs. I mean, it's preservation of capital. It protects the initial investment. There's no loss unless you invade the CD before it matures. So
Yeah.
I just was curious.
I think CDs are a wonderful option for, emergency fund money and short-term goal money. I think it is the most appropriate place for that type of money, right? Money that you have earmarked for those types of things. CDs are a wonderful tool. That's why I was highly recommending the Series I bond in one of our previous calls. The inflation adjusted savings bond issued by the Treasury that was paying, I think high 8% or something like that. Similar idea to what a CD is. Yeah. Great solution for short-term cash.
Well, John, I always appreciate your advice. I've been with you guys a long time, so we get it.
Awesome. Thanks, Dan. Any other questions?
Yeah, John, I have a question.
Yeah, Steve.
Hey, John. So you had mentioned that the only problem you saw was inflation, right? So the Fed raising rates until it gets inflation down to 2%, that and him saying that was going to cause a lot of pain. Don't you believe that that's also a problem? I mean, until it's going to be very hard to get it back down to 2%. He's going to have to keep raising and raising and raising until he does that. That's their mandate. So I got to ask you, I mean, so you don't see it as a problem?
No, higher interest rates in and of itself is not a problem. It is not. I mean, we've seen businesses grow profitability through all sorts of interest rate levels. Some of the largest growth in corporate profitability came in the 90s when interest rates were 7 and 8%, right? That's much closer to normal than what we've had. Super low interest rates for a very long period of time is not healthy. It is not healthy because it discourages an appropriate balance of risk and return. Okay, when all you can get is 0% on fixed income, it over incentivizes people to invest in equities. Okay, and it throws off the normal balance of risk and return. Healthy, reasonable interest rates are good for the long-term economy. But yes, to Jerome Powell's point, I completely agree. It does cause pain when you go from, the sugar high of zero interest rates to like a balanced diet of vegetables and proteins, and we've been on a 15-year sugar high, and it's time to get healthy. So yeah, but again, that does not mean businesses won't be able to create profits in a rising interest rate environment. All it means is we're going to go through a little withdrawals as we come off of this sugar high.
Okay, so negative GDP, does that mean negative growth?
Negative GDP means negative growth, yes.
So haven't we had 2 quarters of negative GDP?
Technically, yes.
So then we have negative growth.
Yeah, sure. But business profits have not dropped. Business profits overall, we have not seen overall business profitability drop. And that's what is going to drive stock prices.
All right. Thank you.
Yeah, no problem, Steve. Any other questions?
Hi, John. It's Ken here.
Yeah, hey, Ken.
It seems to me like energy costs are just spiraling out of control. Natural gas, oil, electricity, everything. I was just wondering there doesn't seem to be any good news coming down the pike. I was just wondering what you thought about the downward pressure of future profitability. Will that slow the profitability of businesses going forward significantly?
Yeah, that's a really good question, Ken. Yeah, so energy plays a part in every step of the business, not business cycle, every step of the production cycle. Is that what I'm trying to say? You have to get goods from one place to another, right? And transportation costs, energy costs play a big part in that, right? Now, as energy prices have gone up, that's been part of the inflation equation that we have felt. Okay, when the Fed, when their big argument was going on between the idea of transitory inflation versus permanent inflation, part of this transitory, this temporary inflation argument was, well, we're just, we're just suffering temporary shocks from the cost of energy and the dislocation of employment and the breakdown in the supply chain, right? If it weren't for high energy prices and it weren't for COVID, we wouldn't have high inflation. Okay, well, that story's played out. Okay, it is clear that there is some fundamental inflation happening in the economy. It's not just this transitory story. But energy prices are one of those very solidly transitory things. I mean, we always go through cycles of high energy prices and then low energy prices. It's a globally traded commodity. And so, yes, Russia plays a key role. Yes, problems with COVID and port shutdowns and all of that play a role. And also kind of the cycling of the economy, to this idea of more green ways of generating energy. Okay, all of those things affect energy prices. But will it stand in the way of business profitability? Businesses will still be profitable despite high energy prices. They're just going to pass it along to consumers. Okay, and so if that ends up decreasing consumer demand, if those higher prices end up decreasing consumer demand, yes, that will lead to a recession. So far, it has not. Consumer demand is still sky high. We can't get enough of everything we want, right? And so can and will the Fed's actions end up putting enough of a squeeze on the consumer that we see consumer demand fall off? That's kind of the big question. And yes, energy prices play a role in that, but they're not the only story, because as long as consumers are still demanding stuff despite higher prices because of those production and energy costs, then businesses are still going to be profitable. Businesses are still going to sell stuff. People are still going to buy it. So I feel like I only maybe 70% answered that question. It was that pretty good?
Yeah, no, that helps. I just wondered what kind of a effect that has on the slope of the curve.
It's a huge part of the formula, but it's also an extremely volatile part of the formula. Yeah. Any other questions? All right, great. Well, I'm going to be sending this out as a recording. Please feel free to forward this recording to anybody who you think might benefit from these thoughts and from these strategies. If you have questions about your portfolio, don't hesitate to reach out. You can just call the office. You can use the link in my email signature to schedule a quick 20-minute appointment. I try to make myself as available as possible. And of course, we have the resource of Drew Brooks here, who's also very available to you guys. So we're going to keep working hard, keeping an eye on the portfolio, keeping an eye on the economy so that we can be proactive in the investment management we do for you and the financial planning that we do for you. So thank you so much. We'll see you all again soon, either in person in one of our review meetings or in our next Zoom call. All right, take care, everybody.
Thank you,
Take care.
John.
John.
Thank you. Bye-bye.
Bye-bye.
Thank you.